Right now, if you are over 65 and qualify, 5 bills can keep pulling money from your account, even when the law allows you to pay less or nothing at all.
One of them can take $3,360 out of a retiree's Social Security checks during the year, even when her final federal income tax bill is zero. No automatic call compares every deduction, state exemption, Medicare program, and household benefit for you.
The bill arrives automatically. The relief usually begins only after a return, application, or form is filed.
Today, I will show you all 5, the exact difference between a legal exemption and an assistance program, and one Medicare trap at the end that can keep charging a widow based on income her household no longer receives.
This is Senior Money Guide. We explain the rules that can turn an ordinary retirement money decision into an expensive surprise using official sources you can verify yourself. And do not tune out because you think this is only for someone poorer or wealthier than you. If you live mainly on Social Security and a modest pension, the Medicare, phone, and utility programs may matter most. If you own a paid-off home, receive larger pensions, or have retirement accounts, the tax deduction, property relief, and Medicare surcharge rules may matter more. Different bills, different income levels. The same problem. The system does not perform one personalized review across all of them. Bill number 1 is federal income tax. For tax years 2025 through 2028, an eligible person age 65 or older can claim an enhanced senior deduction of up to $6,000. If both spouses qualify and file jointly, the total can reach $12,000. This sits on top of the regular standard deduction and the older additional standard deduction for age 65. For 2026, a married couple filing jointly can have a $32,200 standard deduction. If both spouses are over 65, the age-based addition can be $3,300. Add the maximum $12,000 enhanced senior deduction, and the combined deduction can reach $47,500. That is not a $47,500 refund. It reduces taxable income. The enhanced deduction phases out above $75,000 of modified adjusted gross income for most individual filers and $150,000 for joint filers. But now consider a composite example. Barbara is 72. She receives $28,000 a year in Social Security and a $19,000 pension. She has no other income, tax-exempt interest, credits, or special taxes in this simplified example. Half her Social Security plus the pension gives her $33,000 for the initial Social Security taxation test. Under the standard calculation, $4,000 of her benefits becomes taxable. Add that to her pension, and her adjusted gross income is $23,000. Her 2026 standard deduction is $16,100. Her age 65 addition is $2,050. Her enhanced senior deduction is $6,000. Together, that is $24,150, more than her $23,000 of adjusted gross income in this model. Her federal taxable income falls to zero. But Barbara had voluntarily asked Social Security to withhold 12% from every check. 12% of $28,000 is $3,360. Barbara did nothing wrong. Withholding can prevent a surprise bill when tax is actually owed, but in this model, $3,360 left her checks during the year even though her final regular federal income tax was zero. She may recover it as a refund after filing, but she lived without that money month after month. That is why withholding is not proof that tax is owed. Review the actual return before continuing an old percentage automatically. Bill number 2 is property tax. This one is controlled by state and local law, not one federal rule. Depending on where you live, relief may come through a homestead exemption, senior exemption, circuit breaker credit, deferral, or assessment limit. Some programs reduce taxable value, others reduce part of the bill or delay collection. Age alone may not be enough. Income, disability, veteran status, ownership, residency, and filing deadlines can matter. A freeze on assessed value also does not always freeze the entire bill because tax rates and local charges can still change. So make one precise call to your county assessor or property tax office. Which homestead, senior, income-based, and assessment relief programs apply to my address, and which ones are already on my account. Bill number 3 is the Medicare Part B premium. The standard Part B premium is $202.90 per month in 2026, more than $2,400 across the year. For people with limited income and resources, a Medicare savings program may pay that premium. QMB can also protect qualifying beneficiaries from being billed for Medicare-covered deductibles, coinsurance, and copayments. SLMB and QI can help qualified people with the Part B premium. For 2026, the federal QMB monthly income guideline is $1,350 for one person and $1,824 for a married couple, and resource limits also apply. Some states count income and resources differently or use more generous rules. You apply through your state. A local SHIP counselor can provide free help with Medicare savings programs and extra help for Part D costs. Bill number 4 is phone or internet service. Lifeline is not an age-based exemption. It is a federal discount tied to household income or participation in programs such as Medicaid, SNAP, SSI, or certain veterans benefits. Qualified households can receive up to $9.25 per month toward internet or bundled service. Qualified households can receive up to $5.25 toward phone service. The enhanced benefit can reach $34.25 on qualifying tribal lands. Only one Lifeline benefit is allowed per household. Bill number 5 is heating and cooling. LIHEAP can help eligible households with energy bills, heating, cooling, or an energy crisis. It is federally funded but administered through states, territories, tribes, and local agencies. There is no one national payment amount, and qualifying for Lifeline does not automatically qualify you for LIHEAP. Check both separately. Now for the widow Medicare trap. Consider another composite. Ruth and her husband reported $230,000 of joint modified adjusted gross income in 2024. That return can be used for Ruth's 2026 Medicare premium determination, and it is above the 2026 joint threshold for IRMA. Her husband dies in late 2025. Ruth's projected 2026 income falls to $95,000, but the older return still reflects the household they had before his death. Ruth did nothing wrong. The income changed because her spouse died. Social Security specifically recognizes death of a spouse as a life-changing event that can support a request for a new IRMAA determination when household income falls. The form is SSA 44. It does not guarantee approval, but it gives Social Security the death evidence, estimated income, and filing status information needed to review whether the old tax data still reflects her life now. No automatic personalized comparison completes that form for Ruth. Here is what to do this week. First, confirm the enhanced senior deduction and regular age 65 deduction on your federal return. Second, ask your county property tax office for every program tied to your address, not only the one you already know about. Third, contact your state or SHIP and ask to be screened for Medicare savings programs and extra help. Fourth, check Lifeline and LIHEAP separately using their official eligibility rules. Fifth, after the death of a spouse or another listed life-changing event, review SSA 44 before assuming an IRMAA decision based on older income is final. Right now, a qualifying senior can still be paying all 5 bills in full, even when a deduction, exemption, or assistance program can reduce the amount. Not because the relief is imaginary, not because paying the bill proves every dollar is owed, not because you did something wrong, because the bill can arrive automatically while the relief still waits for your return, application, or form. If you found this video useful, subscribe to Senior Money Guide for regular updates on IRS rules, Social Security, and more that can affect your retirement.